Hello and welcome to Talking Automotive with Mark and John. My name's John Sinclair and my co-host Mark Palavestra.
Hi John, today we're going to deep dive where we predict the market and what the issues will be in 2023. The auto industry has had very much a purple patch since the pandemic started, but there are a few things happening that are changing where the industry is at when we look at the macro picture and also the micro picture.
Yeah, it's very interesting the different headwinds that are coming up at the moment, and it's worth sitting back and just assessing what those are going to be and how to counteract or put countermeasures in place that you can deal with when those come along. So great listen, so let's jump into it.
If you like what you hear, remember to subscribe to our channel on YouTube, Spotify and iTunes. Ring the bell if you're watching YouTube, and also visit our website at autocurrents.com.
With 30 years' experience in auto logistics and state-of-the-art locations in 5 major Australian cities, Precar Fleet Services is an independent division of Precar Services, offering specialty fleet fit-outs for commercial applications ranging from simple tray and tow bar fitments to fully bespoke service body and accessory installation. With quality-assured safety, compliance and standardisation of vehicle builds, Precar Fleet Services are a premier all-in-one solutions provider for commercial vehicle fleet operators, leasing companies, and original equipment manufacturers. For further information on how Precar Fleet Services can assist in solving your commercial vehicle fit-out needs, please visit precar.com.au and click on the link to Fleet Services.
Modera is a cloud-based, AI-powered CRM and retail platform aimed at digitizing the physical process of selling a car. The Modera platform sits between existing automotive dealer and OEM systems, providing car dealerships a quick and easy shift to digital ways of working, all done entirely digitally and with total ease.
Mark, just to start things off, can you tell us where do you see the main macro elements that are going to impact the automotive industry coming into 2023?
Well, John, very good question. And we draw on many of our previous 70 odd guests that we've had on the show so far. And with the key learnings from what those guests have told us, we can take snippets from each one and look at what drives certain elements of this amazing industry. So when we look at the first one, we see there's a war in Europe. And what are the effects of that war in Europe? Well, firstly, there's high fuel prices. High fuel prices are a trigger, because it's funny, we talk about the environmental pressures as well. There's environmental pressures to go green, and all the investment is in EVs and hydrogen fuel cell technology. So we're going down this path very much for a green perspective. But one of the key accelerators is in fact costs, because the hip pocket drives everything. The finance director runs a show in every business, because ultimately it comes down to the money. And high costs of fuel increase the adaptation for EVs. So you've got high fuel costs, you've got this trend, this global push and investment in building EVs. EVs are expensive. So these are expensive vehicles with lower margins for OEMs. They're also hard to get the rare earth materials, so therefore there's a high cost to that, and there's all cost in mining that. We talked about that in other podcasts. But the war in Europe doesn't look like it's going to end anytime soon. But there's another compounding effect of that war, is the fact that steel prices are continuing to rise on the back of that, because you're taking a lot of steel out of the European market, which means that the US and other markets have to supply the European manufacturers with this steel, driving costs up. Now, costs have to be paid for by somebody. Now, costs can be absorbed for a certain amount of time by manufacturers, but we're seeing many manufacturers are actually not taking forward orders like they were 18 months ago, where they would guarantee a price if you bought now, even if you got supplied your vehicle in 10, 12 months' time. The cost of the vehicles is increasing significantly, and it's actually eating into the OEM margins, and they can't absorb that cost anymore. It has to be passed on. It can be passed on in two ways. Ultimately, an end price to the customer, or a revision in the margin structure for the distribution channel, and we'll touch on that in a minute. So high steel prices, semiconductors are still very, very much in short supply. It takes 2 years to build a semiconductor plant. So as a result of that, we're still not catching up with what we get lost in 2020, and we're still in this catch-up mode for semiconductors. And if you need more info on that, we've got, if you look back into our podcast of late 2021, where we deep dove into why the semiconductor issue is what it is. And then you've got the other one, the other final one, which is the global shipping shortage. Now, when the pandemic struck, a lot of older, inefficient ships were taken out of circulation and scuttled for steel. Now, that meant that there's a gap now in having enough ships to catch up with that, the shipping of items, whether it be parts, complete vehicles, or other products, gas and oil, etc. So we don't have the ships globally to move stuff around. And there's also a container shortage. So this is where we've seen high costs of logistics, high costs of fuel, high costs of energy to run the factories, and also the high cost of steel. So globally, huge issues. And we've also seen some change in government. So you're getting different policies that are coming into play, affecting the composition of new vehicle purchases and also what the car park will be as going forward. So there's some serious macro headwinds or pressures that will change the status quo from what it even is now and accelerate adaptation to EV. But as with everything, somebody has to pay for this. Now, that's the next question. So, John, your thoughts?
Yeah, Mark, I think you've made a good summary over there. But I think there's also some of the economic elements coming through too with the higher interest rates. And what's your feeling of the impact of those?
Well, interest rates are an interesting one. We've all been sold a pup, whether you're in the US or whether you're in the Asia Pacific area. We were all told that these interest rates would be low for the foreseeable future into the 2024, 2025. Well, the fact that inflation is so rampant in the US and the flow-on effects globally through Europe and also through Asia Pacific means that there has to be this rapid ramping up of interest rates. Now, we had a podcast with Gina McCartney that looked at the correlation between vehicle purchasing and real estate. And those of us with a little bit of the silver on the top in this industry are very much aware of the correlation between house prices and housing buoyancy, if you like, in the real estate market and new car purchases. The wealth effect of having an appreciating and buoyant real estate industry or market flows on directly with a very buoyant automotive industry for new cars and knock-on effect for used cars. So when your equity is shrinking, when your repayments are such that you're putting more money into having to service a loan, your ability to buy a new vehicle and service an additional loan for a vehicle, albeit with a shorter repayment term, puts a lot of pressure on A, you financially, and B, your ability to buy that vehicle. So what we'll see is that the serviceability and ability to actually access funds will get harder and harder given these rate rises have been so quick. So what you may have had pre-approval for 12 months ago, you won't necessarily have approval for that now. So that vehicle, that exotic vehicle, expensive vehicle or premium vehicle suddenly drops back to maybe the next level down. And such is the stratum as you go down into the lower ranks that maybe you can't buy a car anymore because you just don't have the serviceability to do so. So that's going to be a huge impact. So if you can't sell the car, that's going to drop your new order rate. And there'll also be people who are banking on that finance when their cars finally turn up that suddenly can't afford to pay for that car because they're not eligible for that finance anymore. So that's going to be interesting to see where that one goes and what actually happens with those loans. So getting cars sold is the primary area that's going to drive profitability. But the other side of it is that margin squeeze. So the OEMs that bring cars into this country are squeezed from a cost perspective. Cost of materials, cost of vehicles, cost goes up. On top of that, you've got an exchange rate. If the Australian market or whichever market you're in doesn't keep pace with the US, your currency then drops, which means the cost of bringing the car in increases again. even though the raw cost is one thing, but then the cost of actually transacting it is another. So that puts pressure. So when the OEM is squeezed in those two areas, there's only one way. There's one of two things they can do: increase price to the retail consumer, or reduce margin for the dealer.
So, Mark, you're going to have all your costs going up for all the reasons you've summarized so far. But then where do you see the supply? What do you see the impact of supply? So, because you're going to have these costs going up, what's going to happen to supply coming in?
Supply will still be tight because all the factories are still struggling to keep up. Whether you're a Korean factory, the Chinese plants at least have the opportunity to take advantage of this, where they've got capacity and they've got access to raw materials and steel, etc. So the Chinese plants will definitely benefit in the markets that they compete in. And we'll see, you've seen this definitely here for example, the Australian market. But in other markets where they aren't a big player, there's still going to be constrained supply. So supply will still be tight, but it'll loosen up towards the back end of the year as everyone's capacity kicks in and also the demand starts dropping away. Factories don't just get turned off and on like a switch. You've got to ramp up, you've got to forecast your supplies, etc., and get all the raw materials in place. And the key learnings from COVID is when you shut the plant really quickly, it's just so hard to ramp back up again when you need to. So right now all the orders have been placed. So the factories will build those vehicles and they will come. And the bullish markets that have got extra hard, if those markets slow down, then you'll have a matching of supply equaling demand. But then potentially the pendulum will swing where you'll be slightly oversupplied. I don't think we'll have a massive oversupply issue like we had here or globally from an inventory perspective in 2017, 2018 and 2019. There was a huge oversupply of vehicles. The fact that we're moving to EVs is slowing that as well, because the ability to build as many EVs as ICE is a lot harder. So, and you're not as profitable, so you can't just make a whole heap and have them sitting around. So that is one upside. It won't be as bad as, say, 17, 18 and 19, but it will catch up. And I see the back end of 2023 is where that catch up takes place.
So you're going to see, for dealers, the cost of the vehicles are increasing. Your supply is going to start coming back. How will that impact dealers?
What's interesting, the floor plan issue hasn't been an issue for dealers for the last 18 months, 2 years. Floor plan is one of your biggest costs in your business. Floor plan, people, and rent. They're your three bogeys. Floor plan's been beautiful. Cars have been coming in and going straight out, so there's been no interest on floor plan. And whatever interest you did pay was low. Whereas now what's happening is vehicles will be coming in and they may sit a little bit longer and they're going to be at higher interest rates. So that's going to start to cost a little bit more. So you will have increased floor plan charges, one, based on interest rate, and two, based on stock actually sitting around a bit longer. And the cost of those items are higher than what they were back in 17, 18 and 19. So that's one area that's going to be a concern. The next element is going to be, so you've now got staff that it's been hard to attract and retain. So you're now going to have increased staff costs and the risk of losing them because there's been wage pressure is now building. Wages have been have been low for too long. So now in order to attract and retain, you actually have to pay for someone and pay a reasonable wage or salary to them in order to attract and retain them. So the staff are still looking around. The great resignation is still underway and people are looking for the better place to go to. And that's for sales, admin, and also service people, because we as an industry have not invested enough in the service techs. And we've got a podcast on that if you want to have a deep dive into that one as well. It's a very good one where we do a deep dive as to what's the shortages and what can we do about it. So the tech shortage, the sales consultant shortage, and there's also one thing that the pandemic has taught us as global consumers is that you buy online. So there's a shift to online buying means there's less of the traditional, I'll just go in and do my test drives, etc. I do enough virtual research now, you can go, well, I'll buy that car. And with the fantastic initiatives that a lot of the newer players in the used car market, where it's buy and if you don't like it, return the vehicle, gives me that confidence where I'll just go there and buy. I don't need to shop around as much because I'm just confident I can buy that vehicle and it's going to be okay. So there's that, which means that margin squeeze, interest rates, staff, and the other big one, and we're already seeing it now, is this migration to the agency model, whereby the sales channel, where it used to be I would buy the inventory, I would sell it at the prevailing price, that's now going to be controlled more by the OEM, because the OEM is making less money out of this entire business. Me as a dealer, I've never had to worry about exchange rates because I just buy the car at price X. It's not my concern for interest rates or for exchange rates. Whereas the OEM is very mindful of this. Higher cost, lower margin, need to be sustainable, have to warrant and support the product. The distribution channel is where they're going to squeeze it. So that's a huge, I suppose, an area to be aware of, and that you can make sure that you get your rightful percentage of margin, albeit on a vehicle that's going to be a lot higher in price anyway. So ultimately your margins will still be good, but they won't be at the level that you may be currently experiencing now.
And Mark, for used cars, you're going to see supply come back for new cars, but at a higher cost. What do you think the impact will be for used cars?
It's interesting. There's still not enough cars here to support what people, because COVID has made us avoid public transport as much as possible. Public transport's still there and it's working and it's great, but it's nowhere near the pre-pandemic levels. So we still need the vehicles. There's going to be still 700,000 vehicles exiting, and if you need more info on that, we've got a podcast on the whole remarketing and recycling and what happens with the offloading of vehicles. But those vehicles will still exit. We still need to put 1.1 million in as new vehicles. So as long as those prices are up for the newer ones, which they're going to be because they're going to be more expensive, used car prices will still be maintained. So I can't see any dip in the used car price in the foreseeable future based on the fact that the new car prices are still going to be expensive coming in, and there still will be a premium for new car prices. That's just good news for used cars. It's good news for people who are trading up. Not so good news if you don't have a car and you need to buy a car, because it's a bit like the first home buyers. If you don't have a house to upsize in, if you're a first home buyer, well, the forces are working against you. So these are the sort of things that will happen, but there is still strong retained values in used cars. And some cars will obviously be retained more than others because of their desirability and also the uniqueness of them. We had a really good podcast going back over 12 months ago with Santa Amadeo. He, from Glasses, Eurotax Glasses, he outlined experiences within Europe, where certain cars, EVs, had very strong residual values, but some of the vehicles that were no longer being produced, the last ofs, suddenly went from being ugly ducklings to, I wouldn't mind grabbing one of those because it'll be the last of the diesel passenger cars. So that car will last me a long time, even though it's the last one of. So the scarcity drives the price up.
So Mark, what would be the 2 or 3 key things you'll do as a dealer looking forward in the next 18 months? Where would you place your focus to address these headwinds that are coming towards the business?
Well, it's interesting, John. It's a very good question. It gets back to the classic of people and process. So make sure you got the right people, attract and retain, and basically, in fact, we had a podcast on that as well, as far as moments in management, where you reward and recognise. And recognition is probably more important than the reward. People want to be appreciated, so it's making sure that you do appreciate the efforts that various people in your business are doing for you. We know that recognition is a motivator. Money is a satisfier. Recognition is a motivator. So make sure you get the right people in the right places and really acknowledge what they do. And the next one is the process side of things. So systems and making sure you're using, maximising technology to your advantage, because it's going to be, obviously there's a shortage in people, there's a migration onto the online platforms from a e-commerce perspective, people buying online. Make sure you're embracing that and you're maximising your exposure to that. And the other side of it is just the processes within. So to look at your inventory, it'd be great to get more inventory right now, but be very mindful that certain inventory you don't want to get stuck with. So you want to continue to be ahead of the game, engage with the OEM, have a close relationship with the OEM, have a close relationship with the fleet management companies as well. Like we talked about that with Plum Fleet. You know, what's a good relationship with a fleet management company, but very much your customers will put you ultimately out of business if you get it wrong. So what are you doing with those customers? What is CRM process do you have? And single point of contact as far as you can see exactly what's going on, and making sure all your systems feed in so you've got the most available information for the people that you've got working for you. Thank you for listening. Hopefully you got as much out of today as we did in just discussing and bouncing around the ideas. There are some interesting economic headwinds and also some changes that will happen over the next 12 months. 2023 sure will be a very interesting year. Hopefully there is the cessation of hostilities in Europe, and there aren't any hostilities in the Pacific Rim or anywhere like that. So thank you for listening. If you like what you heard, once again, please remember to subscribe to our channel on YouTube, Spotify and iTunes. Ring the bell if you like what you see on YouTube. And also don't forget to visit our website at autocurrents.com.
Yeah, thanks very much for listening.